Does tax-free curl your toes? Well, we're going to talk about Roth with a focus on conversion. All right, grab your favorite mug. It's time for coffee with your retirement coach. In our firm, we get really excited about Roth conversions. And I've got two coaches that absolutely get fired up about tax-free to help us with today's discussion. Randy, Nick, am I wrong?
Not wrong, Aaron. Two of my favorite words.
Yeah.
Tax-free.
My favorite one is free.
It's free. Two very important things that I want you to keep in mind for today's episode. If we are funding a Roth, there's two gateways. There's contribution and conversion. Today's episode, we're going to talk about conversion, and we're really going to focus in on mistakes. One of the things that we see in our firm is we've educated students. We've gone out there and we've preached the importance of filling up that tax-deferred, tax-free bucket, that Roth account, to the best of our ability. And oftentimes, before people walk, they start running.
Yeah. Man, that's so true. And, you know, as much as we have in the past and in other forums discussed the importance of a Roth, why it matters, and how good it is, some things that are overlooked are oftentimes the mistakes that people make when it comes to putting money into a Roth. And what I thought we'd do today, Aaron, is just kind of a bullet-pointed list. Like, you know, these are the things.
Make it simple.
That are, you know, they're just mistakes.
Yeah.
And we want to be mindful of it because, again, a Roth, you shouldn't be scared to do a Roth.
Yeah.
Okay. It's just knowing the rules.
Yes.
Right.
And we don't have to agree with the rules. We don't have to like the rules. We don't have to feel like the rules make sense. We need to understand them and optimize within the current rules.
Knowing the rules lets you play the game.
That's right.
Knowing the rules lets you play the game, and we play to win.
And we play to win. And if we're talking with our financial professionals and our CPAs and accountants, we are playing to win.
And I would add one thing. Don't assume they know. That's another thing.
Yes.
Not everybody understands these rules, and the rules have changed over time, and much to the benefit of the Roth, but they have changed, and not everybody is a believer.
Yeah.
But we'll try today.
I did have a CPA this tax season say, you know, sometimes we get assumptive in what we think people know, and people don't really know about the tax. They were like, but these yeoman's clients, they seem to know.
Yeah.
I have to be ready to talk the talk. And
Man,
I was
that's
like,
a compliment.
That's a
pretty good.
huge
That's a
compliment.
nice
a huge
compliment.
So, Nick, hit us with those bullet mistakes. Again,
Yeah.
some of them are going to make sense. Some are going to feel right. It doesn't matter.
Yeah. Well, and let's start with this. Before you start down this journey, seek wise counsel.
Yes.
I mean, that's always the right thing to do.
We sound like a broken record sometimes, but until everybody's doing it, we're going to keep saying it.
Talk to that wise, tax advisor, that financial professional. Talk to the people that are educated, they understand this stuff, and they can help you navigate. Okay, so let's start off with number one, and I'm seeing this more and more often. And Randy, I know you and I have talked about it. It's converting too much in 1 year. So the act of taking money from an IRA or 401k and converting it into a Roth IRA, if you do that too much, then it is going to trigger an increase in your Medicare premiums.
Yeah.
Right?
So few people realize that your Medicare premiums are directly correlated to your income.
So one of the questions you would ask is, how much could I convert before I would incur that increase into my Medicare premium? That's the question, right?
Yes.
Mistake number two, not coordinating the Roth conversion with your required minimum distribution strategy. Now, here's what I mean, Aaron. If we know that we've got to take required minimum distributions at age 73,
yes,
and let's say we're age 67, we've got about a 5 to 6 year runway to maybe do some Roth conversions, because Roths have no required minimum distributions.
Right.
And if we don't need the required minimum distribution in the future, that's forced taxation.
Correct.
So more money in Roth means we'll have less money in RMD payments in the future, meaning less taxable income. So we've got to coordinate that Roth conversion with our RMD strategy. Mistake number two, and Aaron, oh my gosh, Randy, actually you and I just talked about this. Somebody was wanting to do this, and that is they're wanting to take your required minimum distribution and convert that to a Roth. Disallowed. You cannot do that. I actually know of a client who did that for 4 or 5 straight years and no one caught it. Oops. So let's go on.
They weren't one of our clients, were they?
They were doing it beforehand. All right. So next is forgetting about state income tax exposure.
Yeah.
Now, you certainly have the states like Florida out there and others that they have no state income tax, right? But, if you're in Georgia like we are or other states, that is a concern. Now, Georgia is extremely friendly to retirees with their state taxes, but you got to still be mindful of that state income tax because it could creep up on you. Next, we've got not converting during a market downturn like today.
Yeah.
Aaron, if our listeners get one thing from today, now might be one of the best opportunities to look at a Roth conversion in recent times.
Yeah.
If the market's down today and I do a Roth conversion and I move, let's say, $50,000 from an IRA to a Roth, and the market comes back up, all of those gains are now tax-free versus waiting for the market to come up and that money sat in the IRA and then doing the returns already happened, right?
Something that we do periodically too is instead of converting all at once, if we're going to do $100,000 this year or $50,000 this year, maybe doing it 4 times this year, breaking that into pieces because we really don't know. Like this year, probably going to be a more volatile year. So maybe we don't bet it's lowest. It's going to be today. Maybe it'll be lower a couple of more times.
100% agree. And almost like Aaron, you and I were talking about, it's like dollar cost averaging.
Yeah. Exactly. We have a beautiful lake in our county, and annually they will allow the lake to be drained so the water can go down the stream, right? And most people are not sitting on their docks enjoying coffee at that time. The people that enjoy the lake, typically they're making other plans. But I always see a guy out there from the interstate, and what's he doing? He's there with a shovel and a metal detector. He is looking for the opportunity in the unpleasant moment. And that's what our clients need to be doing. We may not be able to time it exactly right, but in a volatile market, instead of just being like, oh man, the news is just blowing my mind every night and this is just so frustrating, man, get out the opportunity finder.
That's good. That's good. I love that. Next mistake we have is this belief that if you don't have wages, so you're retired, you no longer have a W-2, you don't have a business anymore, that you can't have a Roth or you can't do a Roth. Okay. Well, so here's the thing. If you don't have wages or earnings, then you can't do a Roth contribution.
Yeah.
But if you have money in an IRA or a 401k, a 403b, a 457 plan, you are very likely able to do a Roth conversion. There's no income limits on it. And so as long as you've got your money sourced from those places, you could do the Roth conversion.
Yeah.
The next one, oh man, I hate this one. I hate this one so much. I see this too often. Many times, people who have good intentions advise people when they do the Roth conversion to withhold the taxes from the IRA when they do the Roth conversion.
Yeah.
And that, in my opinion, is a mistake.
Huge.
That's a problem because what you've just done, and this isn't to make anybody feel bad, but this is important.
Yeah.
What you've just done is you've taken money that was in a tax wrapper where the growth was protected from taxes. So tax advantaged money is used to pay your tax bill? No. We use money that has no tax wrappers, no tax protection around it to pay the tax bill.
Yeah.
Right? Next mistake. Letting our CPA drive the plan without any input from the financial professional that's in your life.
Yeah.
This should be a collaborative approach where you've got your financial person, your tax person, both engaged in conversation for your benefit. That's how winners win.
Yeah.
That's how you do it, okay? The most affluent of our society today, the one thing they have in common is their team of professionals communicate and collaborate on the client's behalf. And so having the financial person and the tax person talk together is really, really important.
Nick, where you're going to see something like this, I had a client recently, they came back from the CPA and they said, it doesn't make sense for you. Client was in the mid to late 80s, right? And I said, did you tell your CPA that your goal was to avoid probate and to have as much in the way of tax-free assets for your heirs as possible? They're like, no, I didn't. They went back to the CPA. They said, now the goal is the kids and the grandkids and being tax-free. They're like, oh, well, why didn't you say so? Here we go. So having that collaborative approach, everybody understanding the goals and the plan, it's so important.
Yeah, I think that's a really good point because just like when it comes to investing, somebody might be in their 80s and be very aggressively invested. People, oh, you shouldn't do that because you're, of your age, you won't recover. But what if the money isn't for them? What if they're not using any of the money? They don't need any of the money and they're planning on leaving it to the next generation. So that's what happens when you use these generic rules versus specific rules.
Yeah. So here's the last one I'll leave us with. And Randy, I know you've got a cherry on top. You've got a really good one. And this is, you cannot do a Roth conversion for a prior year by April 15th. Okay, so where the confusion lies is you can make, if you had earnings and you were able to, you qualified to do it, you can make a Roth contribution based on your earnings from the prior year all the way until tax filing date.
Yeah.
You have to do a Roth conversion by the year end of that same year. So you don't get that grace till tax filing date to do the Roth conversion like you do a Roth contribution.
Can I make a comment on that too? If you're going to do that, give your financial institution a little time. We see people make that decision right at the end of the year, and the custodians often won't guarantee that it happened because it's just not like you pushed a button to do it. So try to do those kind of conversions maybe November at the latest. Maybe early December, but try to get them done before that.
I think that's one of the worst things you can hear is best efforts.
Best effort.
Nobody feels good about their plan when it has the words best efforts in it.
So, that was my short list. Randy, I know you've got a really great one. So why don't you hit us with one of the big mistakes you see?
Well, it's interesting. I thought of two things while you were talking. One of them is a mistake we found where brought on a new client and looked at what they were doing, and they were making both contributions to, this was at the recommendation of their advisor, their financial advisor, making IRA contributions and Roth contributions to the maximum, doing both for both the husband and the wife. So they were definitely, and they'd been doing that, as you mentioned, for years.
Ouch.
Yeah. And then I had another client, this would maybe be the third one, but they were making Roth contributions for years for the husband and wife, and they made too much money. Nobody ever caught it or saw it. Of course, I leave that back to the CPA to figure out how to do it. But one of the ones that was most significant, and I think this is because our firm takes the idea of not how I can save taxes this year, but how can I save taxes for the rest of my life?
Yes.
Like, how can I make my life more efficient? Really?
Yeah.
So I have a friend, and they really love their advisor firm. And this particular person had been through some really difficult times with a previous advisor, hired a new advisor with a great reputation, and they are truly good people. But I think one of the things that I've discovered over the years, which is uncomfortable but true, is just because you've got a good personality and a good reputation doesn't make you extremely competent. And sometimes it's a matter of not just competency, but caring.
Yeah.
Like caring to get into the grind and do the extra work. So I agreed to go meet with the client and their advisor. And we sat down and we went through the last few years' tax returns. We looked at their situation, and they were in this gap period. They weren't working, and they weren't drawing Social Security, and they weren't taking RMDs. They were living off of assets that they had saved in the bank and in their brokerage account. Meanwhile, the largest asset that they had, by far, they had a massive, massive IRA.
That was growing.
That was growing.
Yeah.
And so I looked
roughly what tax bracket were they in, Randy?
They're in the 12% tax bracket.
Okay.
But because they were living off of, this was, it wasn't that they weren't affluent. It's just that they didn't have to pay a lot of taxes because of how their income was structured. And they were happy about that. And I made them unhappy because what happened was there was 5 or 6 years that this couple could have done Roth conversions in the lowest tax bracket they'll ever be in their life, because when they turn on Social Security and when they hit RMD, they're going to be up in the 30%, more or less, tax bracket between state and federal. And right now they're at 12%. That for years they could have been doing Roth conversions. And I asked about that, and the advisors, who are, again, they're super nice people, they go, yeah, you're right. So this is why, sometimes you have to understand these, why we do a lot of education with our clients and the community, because it's not enough that we as advisors know. You as a client need to know what the rules are, at least enough to be able to ask questions. This person didn't know anything about the rules. Again, we're very satisfied with the relationship that they had, but there was no tax planning there. And so this would amount to hundreds of thousands of dollars over a period of 5 to 7 years that could have been converted to Roth at almost no tax. And that would have been significant in terms of wealth accumulation. Not only that, now we're controlling down the road part of what the RMD is going to be, because it's going to be on a significant less money. By the time I was brought into that relationship, we did about 3 pretty significant Roth conversions. And now we're in a situation where, because of where they are income-wise, they're going to be in the high 30% tax bracket. There's no room to do it. And we missed a massive opportunity. Many of you may be in a situation where you're missing that opportunity. So if you do nothing else, take from this episode, do an analysis and see what you could do in the way of Roth conversion. And just because, it's popular doesn't mean you should do it, but also just because your CPA says, I don't see how that helps you.
Yeah.
You got to look at the whole picture. What's the family dynamic? What's the long-term game plan?
Well, and Randy, what that makes me think of is, number one, many times our CPAs, who are some of our most trusted advisors, are constantly thinking, how do you save the most money in taxes today?
Yep.
Right.
Yep.
And they aren't thinking over the next 5, 10, or 20 years. It's how we save tax today.
Yeah.
And I think that's a mistake. And I'd say the number 2 thing is that, a lot of people are working with great financial people, but one of the rarest things I see is a financial professional that actually reviews the tax return before making any kind of advice. Almost never. So seek wise counsel and get the coach in your corner.
Yeah, I want to say one other thing so that this is not misleading. I think CPAs do a phenomenal job. Mm-hmm. I think the challenge is that clients see their CPA in the busiest time of the year. They got no room and no margin to deal with the complexities of the things we're talking about. And we are often bugging the CPAs in the midst of the year. And many financial professionals will not reach out to the client's CPA because they think they're deal killers. In reality, this should be a collaborative approach. And we find that when we go to the CPA and we say, hey, this is what we're advising the client, what do you think? More often than not, the client's CPA is encouraged by that, grateful for it, and feels respected, as they should. So the second part of that I want to say is, this is not where CPAs are making the mistake. CPAs are doing what we're asking them to do, but most clients are not asking them to be proactively helping them reduce their tax liability over their lifetime. But a good financial planner that has the right kind of tax awareness in collaboration with a good CPA can make a massive amount of difference, not only to the client and during their retirement, but for the legacy that they're going to leave behind. This done right doesn't just help our clients at this level, but helps the next generation or two if you do this right.
Yeah, Randy, I've taught for years a class at a local university here called, it's just a simple title, Living Tax-Free. Okay. And this tax-free class is all about how you relocate different assets legally to live as tax efficient and tax-free as possible. And one of the biggest feedbacks I get in this class is that people have disqualified themselves from even thinking about a Roth. So if you're a part of our audience today, my encouragement to you is don't disqualify yourself, because this really might be a strategy for you to consider.
Now, I want to challenge that just a little bit. You don't see it in school as often today, but when I was in elementary school, there would be a guy on the playground that was doing his second lap in the 3rd grade, and he would happily liberate you from your lunch money. So if forced taxation is going to help you relive the glory days, of freeze tag on the playground, by all means, leave it all tax deferred, be forced to take it out. We don't know what the tax brackets are going to be then. It's exciting. Or let's embrace this.
Aaron,
let's have these
Aaron,
numbers.
I got to say one other thing. We can't go into all the technical difficulties that Roth conversions can encounter and that you need to know about it. It is simple on the front end,
Yeah.
complicated on the back end, if
Yeah.
you will. But one thing I would encourage everybody who can do it, that has a retirement plan today, a traditional retirement plan, convert at least $1,000 or something like that
Right.
to a Roth to start the clock ticking.
Do a micro conversion, get the clock running,
Get the
work
clock
that
running,
muscle.
and we're not going to go into all the details on that. But Nick, why don't you just spend 2 minutes telling us why that would be important?
Well, I think, again, more time would be needed for this, but basically there are 2 5-year rules that people need to be paying attention to, which includes, keeping from the time you get that first dollar into a Roth. And we're talking specifically about a Roth IRA, so it could be a Roth contribution or a Roth conversion. It's 5 years from that time until you could start taking profit out tax-free.
Yeah.
So just getting it started is an important thing. Now, there's a second 5-year rule that has to do with per contribution until you get age 59 and a half, a little more complex in terms of trying to express that over a podcast. But just be aware there are 5-year rules.
Yeah.
And one more thing, just because this is another mistake, man. I mean, there's so many today, right? But just because you started the 5-year clock on a Roth 401k, does not mean you started the Roth IRA 5-year clock. Those are 2 different 5-year clocks.
Absolutely. Now, listen, our coaches might be exhausting, but this list is not exhaustive. There are other things that can absolutely be mistakes with your Roth. But listen, I want you to do these takeaways for me. And before we get to that, speaking of takeaway, I want you to take this away. Story time with Randy is always great until you start feeling like the main character. Is Randy telling my story? Well, the truth is it might be the case. Someone you know might be in one of these situations. We want you to share this podcast. We want you to save this podcast. If you don't have a financial professional, we'd encourage you to find one. Have conversations to make sure that as your goal of tax-free living is becoming a reality, you're doing it in a way that is appropriate for you and your family. And for those people that you care about, that you know the situations are similar. 1, do not eyeball your conversion. It's never a good idea. We want you to make sure that you calculate it and leave margin. We realize that the ends of the years do not always go as planned, and a bonus should not be a thing that bums you out, right? Secondly, I want you to talk about considering all the taxes with all of your professionals and everybody in your household that affects you. If you're married filing jointly, let's talk about state tax, federal tax, and Medicare premiums. An important piece of that. I want you to be aware that market downturns are a fantastic opportunity to be timing your Roth conversions. And again, you want to work with someone to make sure that you are absolutely taking advantage of that in the best way possible. We want to pay taxes on Roth conversions with money that's not inside that beautiful IRA envelope. We want to pay that with bank money. We want to do that with outside non-IRA money if that's possible and palatable. And lastly, I want to make sure that you collaborate with your advisors, with your CPAs, with your accountants, with your estate attorneys. All of these people should be talking together for your benefit, helping you to ask the right questions and get the right tailor fit for your plan. Get a plan, stick to your plan, stay coachable. Thanks for tuning in today. We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@yourretirementcoach.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. On behalf of our coaches, we want to thank you for listening and for being coachable.
Yeoman's Consulting Group, a registered investment advisor YouTube channel based in Marietta, Georgia. We strive to provide comprehensive wealth management services for every stage of the journey. This platform is solely for informational purposes and is not offering advisory services or sales of securities. Investing involves risk and possible loss of principal capital. Comments by viewers or recognitions are no guarantee of future investment outcomes and do not ensure that a viewer will experience a higher level of performance or results. Public comments posted on this site are not selected, amended, deleted, or sorted in any way. If applicable, certain editing of personal, identifiable information and misinformation may be deleted. The opinions expressed herein are as of the date of publication and are subject to revision due to changes in the market or economic conditions and may not necessarily come to pass. This podcast was filmed at Podium Studios at Marietta Square. Grow your business with turnkey, professional quality podcasting, live streaming, and online events. Don't worry about editing. Don't worry about anything. Just come in and record. Learn more at thepodium.studio. Step up to the podium.